Right, I want this to start. There we go. All right, everyone. Good evening, and thank you for attending the workshop on planning income. My name is Bob Scarfo. I work for Wright-Patt Credit Union in Beaver Creek, Ohio. Many of you may be familiar with our credit union and what we do. Hopefully you are members. And we're going to go through slides tonight talking about retirement income planning, and I'll try to answer questions as we go along. We have about, looks like 10 people on board, so we'll kind of get started. And try to get my screen to move. There we go. Well, retirement is a wonderful thing for a lot of folks. It can be a little scary. One of the major factors when you're in retirement is wondering how you're going to pay your bills. And I mentioned to a lot of folks before they ever get started, you should know what your expenses are going to be while you're in retirement. That means tallying up everything that you plan to be spending money on. We'll go through some ideas along the way, but one of the keys is knowing your expenses. Retirement for different folks means different things. Some will be very mobile, they'll be traveling. Others will be maybe staying at home or just vacations. Maybe you got a hobby that you like to do. Maybe you have other activities you want to catch up on. Maybe spend more time with family or projects you put off for years. Thinking about when you want to do it. Certainly, the average person in Ohio is around age 63. And across the country, it's right in that range between 63 and 64. Most people start thinking and doing retirement. Actually, for a lot of individuals, they're not retiring until they're full age from their Social Security, which is for a lot of folks around 66 in some months or 67. Could be different for you. Doing it, of course, means when you're comfortable to pull the trigger to retire. I recommend that most people work as long as you're comfortable doing it. Maybe you're finding some job satisfaction, building up your nest egg additionally. Those are good reasons to keep working. Others are maybe tired of what they're doing and ready to start another phase of their life. How long will your retirement last? No one actually knows. We can say statistically, most people live to, if it's a man, between 85, 86, women are a couple of years longer. It could go longer than that. You may have genes where you're living up well over 100. And depending when you start your retirement, you might be in retirement 25, 30, 35 years or more. Some of the things you should be considering. Obviously, if you retire sooner than later, you'll have to have more money sooner, because you have fewer years to build the money up. If you retire later, certainly you've got more time to accumulate. Everything's a trade-off. Certainly, if we knew how long we were going to be here, how long we'd be in retirement, it makes things a lot easier to calculate. Certainly, you'll have a longer time to be taking money out of the accounts. If you retire, say, at age 60 instead of 65, that would be 5 more years that you'd be in retirement. You should plan on having additionally funds to help that. Maybe you already have that. Maybe you already have enough money in your retirement programs. Maybe you've got a nice pension. Remember, your Social Security for most people will not start at the earliest until age 62. The other thing that you need to be thinking about, of course, is going to be your medical care. Most individuals get medical care from their companies in some kind of insurance. And once you're in retirement, that'll be up to you. Now, once you're over 65, everyone can get Medicare Part A. That part is basically a free program that the government has. However, to make it look like real insurance, you have to get another supplement. Part B is one of them. There's a ton of other gap programs you can buy. Certainly, we're not going to go into all the medical things you can do in retirement. That we actually have whole programs to talk about that. But that, for a lot of folks, your medical care is very, very important. Do not try to wing it if you retire before 65 and say, well, I don't need my medical for a few years, because that could be a potential financial disaster. Also, your medical, for a lot of folks, will be their biggest one expense when they're in retirement. Certainly, if you're going to get a pension, starting it sooner sometimes gives you a smaller amount. Starting it later may be larger. For some people, it doesn't make a difference. Some programs say after you get so many years, your pension's the same. So then your question is, do you want to still work? Did you like it? Or if the money's not going to be different, maybe you're going to retire sooner because you've got the money to do it with the pension. Certainly, if you delay your retirement, the advantages are, of course, you have more time to be saving before you retire and less time in retirement to enjoy it, but also you don't need as much because you have fewer years that you'll be drawing down. Of course, the longer you wait on taking your Social Security, you get an increase between the ages of 62 up to age 70. There's an 8% a year addition. So by delaying your Social Security each year, you will get a larger payment by delaying. It's a tough decision. Particularly if you're not very healthy, I would suggest you consider taking your Social Security earlier. Of course, if you're very healthy, you might say, I'll wait until I'm 70, but there's no advantages whatsoever waiting past age 70 to turn on your Social Security. Of course, when you decide to retire, health may play a role. For some individuals, they like what they're doing and they're going to work until their health changes. But for most individuals, at some point, they say their health has changed enough that they're decided to be in retirement and get some years that they can do other activities. Working during retirement. Some people do that. Some people retire from their one profession they did for a long time and but decided they don't want to stay home the whole time, or maybe they just like to be busy, or maybe even want the extra money. And certainly working retirement you can do. There's some things you need to be aware of. It may affect your Social Security, the size of your check by working, so you may hold off taking your Social Security until you decide not to be working totally, but some people still do. There are limits. That's about $18,000 a year you can make up until your full age, and that would be for Social Security reasons of 66 and some months or 67, depends on when your birthday is, where you can only make up to about $18,000 a year without giving back some of your Social Security. Of course, working retirement, supplementing maybe your Social Security, other things to pay bills, or for more for travel or other things you like to do. And also keep you maybe from spending your savings and stash. Some part-time jobs offer health care, which might be less expensive than paying for your Part B insurance with Medicare, or cheaper than the gap. So sometimes employers will offer that, and maybe you can take advantage of it. Certainly, we talked about there's an effect on Social Security by working while you're in retirement. And of course, there's some other non-financial benefits. A lot of times folks like to do something different than being around other people. They enjoy that, so that could be a benefit to them besides the financial rewards. Some people like to phase into retirement. What does that mean? Instead of just going cold turkey and leaving their employment totally, some companies are allowed to do job sharing, which maybe you share your position with someone else instead of working full-time. Maybe you work only 20, 25 hours a week. Maybe you do that for a while until you feel you're ready to be 100% in retirement. How long will it last? Because we mentioned this before. We don't really know how long your particular retirement will be, but most people will probably live at least 20 to 35 years in retirement. If you retire like you're in your 50s, well, it might even be longer than that. First, people are now living longer, and with medical science like it is, there could be other cures and things for ailments that help people live maybe well past 100 or more. And if that's the case, maybe your concern then will be, do you have sufficient income to last through that time, the resources. Okay, some of the main goals in retirement. Of course, I always tell people that you should always know what your expenses are going to be. But one of the things you want to know is like what you're going to do when you're in retirement. Obviously, if you're traveling a lot, that would be an expense. If you're golfing a lot, that would be an expense. If you have hobbies, some hobbies cost hardly any money. Other hobbies cost quite a bit. So you have to account for that. How's your budget going to be? Most individuals in the first 5 years of retirement tend to be pretty active, and they tend to do their traveling up until the first 15 years of retirement. Also, a lot of the other things we want to catch up on. So understand you may have some additional expenses that you don't have right now when you're in retirement the first few years. Of course, there's always a risk if you spend too much too soon and use up your resources too soon that maybe you won't have enough later on. Of course, there's always unexpected things that can happen. So you know how life is. Sometimes things happen at the most unfortunate times. So try to keep a reserve. Estimate how much income you're going to need, and the best way to figure that out is to take a look at what your bills might be. What's it cost to run your household? Everything. If you've got gas heat or electric heat, your phone, water, trash, money that maybe you give to church, other organizations. What is the real cost of running your household? You should know that before you ever decide to retire, so you know how much you need to get just on the basics. Consider also that the price of stuff changes. Think about it when you were younger, what it cost to buy something. Maybe when you're younger, you used to go out and buy a Coke or a gallon of gas. What's that run now? This means when you're in retirement, inflation is not going to stop. Chances are you're going to see prices maybe double during your lifetime in retirement. What will that do to your resources? Then figure out where you're going to get your money to pay the bills. So first you figure out what you need, then you figure out where you're going to get the money to pay it. Add in for travel. If you like to travel and go places, in the first few years, is it going to be 5,000 in a year or 10,000 in a year, or is it just going to be a few hundred? It's going to vary by individuals. Also, some individuals, while they're in retirement, decide to upgrade their kitchens and their bathrooms and their living rooms and other projects they've been meaning to do. Figure that in also and how it might affect your resources in retirement. But whatever you have in a way of income coming in, take a look what your expenses are. And when you subtract one from the other, is it a positive or is it a negative? If you're short, then that means you're going to have to draw down from your retirement plans. So if you have a 401k or thrift savings plan, Roth IRA, something like that, where you can draw from, just figure out how long you're going to be in retirement and start maybe drawing that down from there. Too soon, too much, probably not a good idea. Too slow may not be a great idea either, because you want to be able to enjoy that money. Probably not necessary to leave a bunch for family unless that's one of your intentions. Of course, you're going to use your resources always to fill the gap between what your expenses are and your income. For a lot of individuals, they're going to have in the early years more income coming in than expenses, and therefore it's going to be easy and not stressful. But for some, it'll be close. And that's when you're thinking about, do I work that part-time job or do something else to, pick up some extra money or cut back on certain things. One thing I do for my clients and our members is a plan on the computer called the retirement plan module. It's something that we offer to all the members. You do have to be a member of the credit union, and it's a plan that we'll give you that will put the mathematics out for you. What we need normally is the information about you. So if that's something of interest, you could contact me. I think at the end of the slides it has my name and my phone number, but I'll repeat it now anyway in case you don't stay to the end. My phone number at the credit union is area code 937-912-7850. 937-912-7850. And that's maybe setting up a plan for you. We can do this over the internet, through the program, kind of like we're using today with WebEx, or have you come in for a one-on-one meeting in person if you're comfortable. We do have protection for that. So, and let me pick back up on the presentation here. How much annual income will you need? Again, we talked about trying to make those bills. So that's the first thing. And you're going to have three basic areas of bills. You're going to have your basic budget for your home. You're going to have your travel and the medical. And for, like I said earlier, for a lot of people, the medical might be their largest bill in retirement, particularly if you retire before you're age 65 and you need to get a private policy. And that can run a couple, maybe $1,000, $1,500 a month. Of course, there's guidelines out there saying how much money you might want. These are rough numbers, of course. People say, do I need as much as when I'm working? Actually, in the first few years of retirement, you might need more because you might be doing way more things than you thought you were going to plan to do. I encourage people to take some initiative to do things when they're a little younger in this early part of their retirement and travel and do those things. It's just respectful of how you do it. Certainly, you can do trips a lot of different ways, flying places, staying at maybe different hotels, or maybe instead you do camping in lieu of that, or you travel by car for a certain amount of it. And there's lots of ways to keep expenses down and still have fun in retirement. Think about how things might change. Certainly, we encourage strongly most people to have their homes paid off when they get into retirement. It's not always possible for everyone, but usually it's much easier in retirement if you don't have a large house payment or a large rent payment to deal with. Then your major focus is going to be hopefully having some fun, and of course you have to take care of that medical. Of course, if you've got hobbies, depends on your hobbies. For some people, the hobbies aren't very much. For others, they could be spending $1,000 a month on a hobby. It's a pretty nice hobby. List your expenses. Make sure if you're married or you're a couple that you talk over these things. It's always important so no one has surprises. You should be on the same page of what you think you expect out of retirement, what you want it to be. It can be pretty much what you want it to be. You talk over your plans, maybe your objectives. Maybe you want to travel a certain amount first, and you do some things in the house next. There's no perfect thing. It's a matter of what you're both going to be comfortable on. If there's two of you, if there's one of you, pretty simple. Make your decisions and do what you want. Of course, again, we talked about the largest expense for a lot of retirees once they get past the travel phase is going to be their medical. And the medical, of course, could be hindering for some folks, because if you're paying a lot out because you retire before 65, that can really put a dent in the budget. After 65, you're still going to do co-pays. The normal Part B is about $134.50 per person, but that may not be enough with Medicare. If you want to do a Medicare Advantage, it might be included some things that you want. If you definitely want dental, you want eye care, you want some of these other things you might be used to, you're probably going to be buying gap coverage, and that will increase your cost. It wouldn't be unusual for a couple to spend maybe $800 in retirement per month, even though they have Medicare, just paying for the supplements. Again, it depends on how much you want to pay out of pocket. If you're real healthy, maybe you just do the Part B. For some folks who have health concerns, particularly medications, you may want to sign up for Part D. That's a separate kind of insurance. Again, I'm not going to go through all the stuff on Medicare because we have a whole presentation on that. But these are things that are real. And if you talk with a lot of folks in retirement, they will mention to you that care is really, really important. Okay, one thing that people think that maybe Medicare will pay for and it does not, and it's highlighted on the slide, and that happens to do with long-term care. Long-term care is where you're being taken care of at an institution or at home with some other person helping out, and that usually is not going to be paid for if it's not caused by a medical situation that can be remedied. If it can be remedied, then your Medicare may cover it until that's remedied, but after that, It's just strictly a care thing. You're on your own paying that unless you've gone out and got yourself a long-term care policy to help with that. By the way, long-term care can be very expensive, depending on the degree. It could be anywhere from 5,000 to 6,000 a month. It could be as much as 10,000 or 12,000 a month, depends on the level. For people with dementia, Alzheimer's, unfortunately, it takes 24/7 care usually, and that can be 10, 12, 13,000 a month. Other care, not as much. If you're just simple, or maybe you're just doing assisted living or living in a place that would be a lot less costly if you don't need as much of that type of care. Actually, not everyone will need long-term care, but the odds are pretty high. For women, it's over a 60% probability. For men, it's a little under 50% probability that you will need the long-term care. Some people say, look, I've got family that's going to help me. Well, that'd be great if that's true. But ironically, for most people, their families find it difficult at some point to take care of them. Major factors for you to consider. Account for inflation. Even though you say when you retire, let's say your expenses are $3,000 a month and your income is $4,000 a month. You say, well, I got it made. You might have it made for 5 years or 10 years, but the cost of stuff goes up, and all of a sudden you're scratching your head and saying, how am I going to make my bills? Most people tend to downsize in retirement anyway, and maybe you think about going to a little smaller home that's easy to take care of, less work to take care of it, and also maybe the bills will be a little bit less, and that might be one factor. But understand there probably will be inflation while you're in retirement. Recognizing the impact of taxes. Obviously, if you're just living on Social Security, and some folks unfortunately will be in that situation where they don't have other resources other than Social Security, then you don't have to worry about taxes. You won't be paying taxes on Social Security if you're below those limits. And for most individuals, they'll have either a pension or they'll be drawing out of 401ks, a thrift savings plans, a 403bs, a 457 plans, some kind of retirement plan. When you draw out of that, that adds to your taxable income. Plus, if you happen to be working, that'll also be adding to your taxable income. So you may have some impact. Your taxes may not be as bad as a percentage as when you're working, but there'll still be some taxes more likely you'll be paying when you're in retirement. Now we'll talk a little bit about investing. Certainly, when you're in retirement, you should be invested with the least portion of your money to get you some growth. Doesn't mean a lot of money, but at least some. They have it 100% in something safe right now. For example, if you were in retirement right now and say you had $500,000 and you had it in a savings account paying you a couple tenths of a percent, probably that's not a good thing, because even though you might have that much money, it's not going to make you hardly anything when it's making a couple tenths of a percent. And when inflation right now, which is relatively low, running about 1.8, that's a losing proposition. So you normally want your overall investments to be making more than the rate of inflation. And if you can stand the ups and downs of the market, maybe you put in half your money or a certain amount in that you're comfortable with. But you should not have at all, certainly in the markets. This gives the example of how inflation affects everything. And you can see that the price of stuff in a matter of 25 years could maybe potentially double, could be more or less. Again, if you think back in your past, in the last 25 years, when something's gone up. When my parents bought their first house, it was $17,500 for a 2-story colonial. Whereas today it's worth probably $150,000. So things go up over time. Okay. Normally you're going to have taxes on your interest. Of course, right now, like I mentioned earlier, most people are not having a problem paying taxes on interest because they don't have much interest from their investments. There could be special tax rates for long-term capital gains. We don't know how that's going to change. Right now, Congress and the administrations have changed, so taxes could be something coming up later this year or next year that may change the rate on long-term capital gains. The current rate is at 15%, unless you're a person making over $425,000 a year. Most people 15%, but that could change in the next year or two. Tax-free income. A lot of people don't really need tax-free income. Normally you have to have a retirement income over usually 100,000 to make it worthwhile, and most retirees are not in that range. In fact, across the United States, the average couple in retirement is usually living on about 35 to 40,000 a year, a single individual between 22 and 25. Special rules for tax advantage accounts. So again, it pays to know some of the rules if you're doing something special. Understand risk. There's different types of risk. Market risk is pretty obvious. Obviously, the last decade has been pretty good for the stock market. So if you had any money in the market and decent stuff, you've done very well. You've over doubled or tripled your money in the last 10 years. By the way, that is not normal. You normally expect to double your money about every 7 to 10 years. So we've done better than that. We've had unusual yields. But if you look at the money that you make in CDs and things, those rates are the lowest that we ever have seen. Of course, interest rate risk has to do with your buying bonds. Certainly, if you're in bonds right now, you might be getting a little worried that interest rates go up, your bonds might lose some value. So just keep an eye on that. Three-legged stool. This is where your money is going to come from in retirement. You should have money coming from Social Security or maybe a government pension, maybe a corporate pension. Most people don't have a true three-legged stool anymore because a lot of people don't have a pension. But then one of the legs of the stool should be your stuff that you have saved, either bank accounts and 401ks. How do you decide on your Social Security? We'll spend a few minutes on this. By the way, we do a separate presentation on just Social Security by itself because we can really go in depth, and it usually takes about 35, 40 minutes just to cover Social Security. One thing I would say to you that whenever you plan to turn on your Social Security, make sure you contact the Social Security office at least 2 months in advance of when you want it to start. And by the way, your start month, you don't technically get it on that month. If you said I want to start on the first of the year, your first check will be actually come on the second month of the year. Or if you want to start in the middle of June, you have to actually become technically started in the middle of May because it takes a month for them to start it up. You should go to one of the offices. Just a side note here, offices in the Dayton area. There's one downtown. There's supposed to be one on the west side of Dayton, but there's certainly one over in Xenia and one down in Middletown. If you're in Springfield, there's one up in that area too, I believe. So check out where your Social Security office is. When you get ready to go, certainly go in if you can. You normally have to go on the phone and call them, and many times it might take you an hour before you get through. Sorry, a little discouraging. You can sign up online for Social Security. If you do, you have to send in a copy of your birth certificate, which some people might be uncomfortable with, and your copies of other things. So just understand you may want to do that in person rather than through U.S. mail. Okay, figure out when you want to start your date. Social Security is a form of insurance. You have paid for it. This is not something that was free. Some people, even though it's defined to be as a benefit from the government, you've really put money into the system. You have earned it. And your employer or employers over the years have also put money in toward your Social Security. And they're putting in almost as much as you are. In fact, I think they put in a little bit more. You're putting about 6 3/4% of your paycheck, and they put in right around 7%. That money builds up over time. So when you start it up, the system's made that supposedly, when years and years ago when it was designed, most people would pass away by 78 or 79. So it didn't matter when you started getting your checks, it all average out. But that's not true anymore. Most people live up past 78, 79. So by delaying your Social Security, there is actually a benefit of getting more payments out of the system if you think you're going to live past, let's say, age 79 or 80. First, earliest you can apply for normally is going to be age 62. Are there exceptions? Of course, there's always exceptions for everything. There's an exception if you become disabled. That's a different side of the Social Security system where you get a disabled payment. And once you get to be full age, they flip you from disabled Social Security to your regular retirement Social Security. You could also get it before age 62 if you're a widow or a widower and you're a widow where it was taking Social Security, you might be able to get it at age 60 through the retirement system. Okay, your benefits, of course, earlier you start, you're going to get less. The later you start, you're going to get more. And those payments, they get inflated every so often by a cost of living factor. So your Social Security that you start with will be one number, but probably within a few years, you'll notice that it goes up slowly. Understand what Social Security does. They also ask to take money out of your Social Security check to pay for your Medicare Part B. So in many cases, you don't see your check going up because your Medicare payment Part B tends to go up faster than your increases. So some folks say, well, Bob, my Social Security check didn't get any bigger because even though there was an increase, it got ate up by the medical side of the equation with Medicare. Okay, again, you want to figure out when you want to start getting your payments. If you have poor health, I would encourage you strongly to maybe retire sooner. Take your Social Security as soon as you can, even though you don't get your Medicare until you're 65, and you'll have to pay out of pocket for medical for those 3 years. Or if you're getting the COBRA, usually lasts 18 months, and many times people will stay on their COBRA up until about a year and a half before maybe they're 63 and a half, and that way if they do that at 63 and a half, they get enough to get through age 65. How did they calculate what you get? It's a pretty complicated formula. There's different sets to it, but one of the things to understand is that they take your highest 35 years and they adjust that for inflation. So maybe one time 10 years ago you made maybe 30,000. In today's, maybe that's equal to 60. They're going to give you credit as though it was 60,000. You may have some years that were older years that are worth more to your benefits than the newer years, even though you might be at a higher rate now. It just depends on how much inflation was at the time going backwards to when you got paid before. If you have 0 years, let's say you didn't make 35 years, you only worked 20, well, you're still going to get a benefit, but they're going to put in zeros for the other 15 years. So it's not going to, unfortunately, your payment's going to be somewhat limited by the number of years you didn't make 35 years. I would encourage everybody on the call today, make sure you at least get 10 years worth of service in with Social Security if you plan to take it. They call that in quarters. It's 4 quarters in a year, so there's 40 quarters of work. Double check to make sure if you have that, and that may be some extra money that you'll get in your pocket because you'll qualify. If you don't get 40 quarters in, then normally you're not going to get Social Security based on your own. Now, could you still get Social Security? This is something I'm going to tell you that some people don't understand at all. You could get Social Security off a spouse if you've been married to them for 10 years, whether you worked a day in your life or not. You can get at a rate of about 50% of what they would get, but they have to apply first. You can get 50%. So let's say your spouse is going to get $2,500 a month Social Security, and assume that yet your ages are pretty close. And if they're getting $2,500, well, you would get $1,250 based off of them. Now, maybe yours is higher. Maybe you say, well, my spouse's is $2,500 and mine is $2,000. Well, then you're not going to take a spousal benefit. You're just going to take your own benefit. You can always find out more details on this by going to socialsecurity.gov. Make sure you're going to the right website. You don't want to give out your information to an incorrect website because there are some that are similar. You can get statements on your benefits too by applying for them. They used to send them out every year, but they haven't been doing that. They would go into employer pension. Not everyone on this call is probably going to have a pension, if you bear with us. For some, you're going to have options to get a pension. Maybe you work for a company for 10 years or 15 or 20 or 30 or 40 years. Many of them have a formula. Make sure you understand your formula. There may be a point in time where the formula doesn't change or the number of years won't change things. You need to know that because if you said, well, I worked an extra 5 years and heck, I could have had the same pension 5 years before, maybe I should have retired 5 years sooner. Unless, of course, you're really enjoying the work, then it wouldn't make a difference. But understand your plan. No one's going to be more caring about you than you. So you have to take the the initiative to check out your plan, where you work, and know the details. Ask your human resource person at where you work. They should have a booklet or something explaining exactly how you earn your pension if you're going to get a pension. Understand when the pension amounts are and how they get paid off. Most of the time, your pensions will have options if you're married. That means you may take a reduced pension amount in order to cover you and your spouse. And many times I recommend to people to consider that. There's also reasons maybe not to, but usually if something happens to one of you early in retirement, if the other person still has that source of income, it's going to be very helpful to them. You do it on just your life. You do it on a joint life. That's what that QJSA means. You have taking a lump sum. Sometimes taking a lump sum could be a better deal if you can get a better rate somewhere else. Shop it. Then other times, particularly for the public sector, they're heavily subsidized. Many times you're not going to get a better deal by shopping it. I know we have people coming to us all the time with public plans. Maybe they're part of the school system, maybe they're part of other systems, and it usually pays for them just to stay with the pension that they're getting from their school system. There are some exceptions to that. Some of your plans, like the public ones, do usually go up by the cost of living, but the private ones do not. So if you're working for, say, like a General Motors, and they may not have a clause that increases your pension, so maybe they start you with a pension of $2,000 a month, and maybe there'll be $2,000 a month 25 years from now, even though the cost of things change. And if you're in a public one, like the teachers or state or federal government, their pensions many times have a cost of living. Maybe it goes up by 1 or 2% a year. That could be very, very helpful. Understand your benefits. Understand the terms of the benefits, when they can kick in. Again, if you're not sure, contact your human resource people to get that information. Then we're going to go back to where we started. Again, making sure that you have enough money in retirement. That's what retirement income planning is. You take a look at where your sources of income are going to be coming from. Then you figure out all that income that you're going to have. Then figure out what you're going to do with that income. What bills are you going to pay? Are you going to use some for travel, for hobbies? Is there going to be money left over? Maybe to save up for the next year. Maybe you're planning a bigger trip 2 years down the road. Okay, when it comes down to investments, and I won't spend a lot of time on this, even though I am a retirement planning specialist and been doing investments for over 30 years for folks. I don't want to spend half an hour going over investments right now. Everyone has their own risk factors. So you have to understand what you're comfortable with. No two people are identical. So asking a friend at work, hey, what do you do for your investment mix, is probably not a good idea, because their idea of risk could be totally different than yours. And many times there's companies out there that put out these things called target funds. You probably have seen them in your plans at work. They might say like 2020, 2025, 2020, 30, and so on. And they have a plan that adjusts the mix between risk and less risk for you. And I say for most people, that's not a good thing. It helps in only those people that don't have a financial advisor, because if I said to everyone right now on the call, let's talk about ice cream for a moment. I said, well, everyone loves strawberry. And a lot of you I can't see your faces, but a lot of you, I don't know if I like strawberry, Bob. I like chocolate, or I like pecan, I like whatever. Same thing when it comes to these funds in the 401ks that are set for certain retirement dates. They're not perfect for any more than maybe 30% of the people, yet they're in all the plans out there. Usually it's better to figure out what you are comfortable with, how much growth you want. And that means when you're picking some growth, you're going to have some risk. Also, if you stay too safe, most of the safe stuff in plans is only around 1%, 2%, or some are only at 0.5%. A lot of them aren't keeping up with inflation. That may not be what you want to do. I mean, do you want to have the same money equivalent 20 years from now, when maybe your needs are greater? You may have to take some risk just to stay up. But don't take more than what keeps you up at night. So don't go out there and get crazy and say, well, I'm going to really let this thing go. And then if it drops for a while, like last year, we had a drop in the market that was down 35%. It was short-lived, but it was pretty scary, wasn't it? Most of it, if you had money in the market, you know what I'm talking about. What's your withdrawal rate? Usually we tell people you shouldn't be withdrawing from your accounts more than 5% a year. Some say 4%. So I would recommend very much that you be careful. Don't be drawing out 10% a year unless you think you're terminal and you're going to be gone in a year or two. So that rate figures no more than 4 or 5% of your investments should be used up each year. Normally, there are some exceptions. If you want to know more about that, again, you would come in for a plan, or we do a plan for you over the internet. By the way, there are no costs for the plan. My number again is 937-912-7850. We'd be happy to do that, but we can go in and change the rate of which you're using your money so you can see if it's going to make it there or not. Order of withdrawals, do you take the money first out of your pensions first, or your 401ks first, or out of your Roth account first? That you have to think about. Oh, someone just sent me a little note about Twitch don't perform well. Okay, so she said that these don't perform. She was referring to the target funds. Again, I like with my clients to sit down and spend the time with them to go over a mix that's absolutely correct for them. So we're not doing something that's general for the rest of the public. Each person has their own risk tolerance and time horizons. Thank you for that. Okay, required minimums. At some point in time, your retirement plans, you'll have a requirement to take money out. For some folks, they say, well, I don't want to do that. I don't need it. Why do I have to take it out? Well, I didn't make the rules. If you've got a 401k standard or a traditional IRA standard, those at age 72 now, you have to start taking money out. If you have a Roth, you don't have to take money out ever. You don't have to. But if the others, when you hit age 72, you're going to have to start taking out, and that will add taxable income to your other income that you have. And it may change your tax bracket. What some folks do, they sometimes give their RMD or part of it to their church or to a charity that they like, and that way they don't end up paying taxes on that portion. Just something to think about. Okay, at some point in time, you will transition normally from accumulating money to money going down. So if you looked at your overall accounts and say you had in there a certain amount of money, maybe in the early years of retirement, it's still building up. Maybe because in those years, your expenses aren't as high as your income, and therefore you're putting away extra money. But there may be a point in time where, again, your expenses start exceeding, your income, and now you're starting to draw down. So you'll start seeing this drawdown. For some people, they see a drawdown starting in their 80s, some in their 90s. It could start even sooner than that, but for a lot of it depends on what their balance on the income expenses are. It's not until a little bit later in retirement they start seeing their funds go down. Understand this. We took a survey with folks out there and said, does money, by the way, money is not an end all, but it is a tool in your life. And for a lot of folks, having a little bit more gives them a better sense of financial security. So with that in mind, just understand maybe at some point when you see it start diminishing, that may create some insecurity. Okay, immediate income versus long-term returns. Again, when you're investing, you need the money now, or can you wait a while to get it? The longer you wait, usually the better returns are going to be. Obviously, when you're in retirement, you have a clock, right? And that's the end game. So we don't know how long we're going to be here on this planet. So, you can figure, well, do I defer? But maybe at some point you say, I'm not going to defer anymore because I want to use up those funds or give some of them away to family or church or charities or whatever, helping somebody else maybe. Okay, asset allocation plan, basically, how much money do you want to be in something safe, and how much money in medium risk, maybe how much money at higher risk, and is it going to provide you the income? Do you need that income? Again, each of you are different. Everyone on this call isn't going to have the same question about this at all. You're all going to have your own questions like, well, what do I need ongoing income? Well, you have to have enough to pay the bills. If your normal bills every month are $2,500, you got to figure out where's that coming from. Is the Social Security going to cover it? Is some pension going to cover it? Is it maybe $1,000 a month from the 401k or thrift savings going to cover it? When you get questions, you can always call Again, some people are not comfortable with anything to do with the markets. There might be some people said, look, if I put money in an investment and it went down a couple $100, I am so done. I can't stand that. I would keep me up at night. Then you're not a candidate to be in the markets at all. I can tell you until the cows come home that you can make a lot more money in the long run with the stock market, but in the short time, you could lose money. And it has to do with your personality if you can deal with that. And it's not up to me or any other financial advisor to tell you to take any type of risk. It's really your personal decision. Again, you want to make sure that if science and technology and medicine get better and better, and all of a sudden you're a lot further along in retirement than you ever thought you would be. I mean, I have clients right now that come in that I meet, they're in their 80s and 90s and say, Bob, I never thought I'd ever, get to be 90. It's one day at a time, right? We all age one day at a time. Certainly you want your funds as much as possible to keep up with inflation. Right now, all the savings rates out there pretty much are not doing that. And just about every American who has money in a savings account, checking account, that is paying less than 1.8% is actually losing value. They're not losing dollars, but they're losing value. And then we'll just talk briefly here. You have lots of choices on investments. I'm not going to go into the investments right now. Certainly, you have to be comfortable. Many of you may already have a financial advisor. You should be talking with them, and you should be planning for your retirement. You should be doing these programs and getting this information so you're prepared. So when you do pull the trigger, you have all the information you need to be informed. And a lot of you may or may not own an annuity product. Basically, it's like dealing with the bank, only it's different. The insurance companies have their own products. Many of those products act like certificates. Some have fees, some don't have fees. You certainly want to look at what you're getting into, but there could be something there that could be very valuable for you, particularly if you're looking to get a stream of income for life. Sometimes right now we have an annuity company that does have a nice rate on their fixed rates that's above the rate of inflation. But again, you have to feel that you're comfortable. Everything in the way of investment has a pro and a con to it. And you have to look at that investment and say, is there more positives about it than negatives? There's no perfect investment. If I said to you, hey, there's something out there that's paying an outrageous rate of return and it's all guaranteed, if it sounds too good to be true, it probably is. Okay. Again, we talked about taking money out of accounts. Typically, 4 or 5% is the number. 6% would be a high number. If you have more in the markets, and of course the markets have been doing very well, you might be able to maintain a 6% drawdown. But if you've got a fair amount of your money in something that's fixed, I wouldn't go higher than 4%. There's some people even saying 3.5% now because the interest rates are so low. I'm not so sure of that myself, but everyone has their own personal ideas on this. But I'm saying between 4 and 5%. So if you said I've got a couple $100,000, figure out taking it 4 or 5% of that year out, it'll probably only last. All right. Okay, your retirement years aren't all going to be equal. There'll be years in the beginning that you're spending more money traveling, fixing things up, than later years where you maybe don't spend hardly any money at all. So where do you take your money from when you do need it? You take it from the tax deferred account. You take it from a tax exempt like a Roth. You take it from maybe your savings account. That all really depends. It depends on the year, what your income is, and if a little bit more income is going to flip you into a higher bracket, maybe you take the money out of your Roth instead. And maybe take money out of savings, which is not going to push you up in another bracket. In other years when your tax bracket's lower and you think you have some room to take out additional from your retirement plans, maybe that's what's to do. You can also be doing along the way Roth conversions. That's when you take money from a taxable IRA and put it into a Roth that becomes not taxable down the road. Be careful how you do it. Normally, I don't recommend people to do Roth conversions until they're actually in retirement, where the tax bracket tends to be a little bit lower. It's a nice strategy, particularly if you want to leave a lot of money later on to people that they don't pay taxes on. And that's your choice, of course. Some people say, look, I don't want my kids to worry about taxes. doing some Roth conversions would make sense, but you have to be extremely careful not to go over certain levels of income as to put you in another tax bracket. Income concerns versus estate planning concerns. And I do have some background being a trust officer for over 6 years in the past, talking with people about their estate planning. And by the way, I do more than just retirement planning for people, more than investing. We talk about all these different things because they're all really connected in one way or another. You'll find out that your income affects your estate because down the road, the more you build up, you have a house, cars, maybe extra properties, maybe a rental, all your investments, they all came from a source of income at one time or another. And they all become part of your estate when you pass. You have it set up, and that's another thing we talk about all the time. Make sure that you have 4 basic documents. You should each have a will, a power of attorney over each other's finances, a power of attorney over your health care, and a living will. Some people may also need a trust. But either way, when you're in retirement, you might say, well, Bob, we've been so busy working, we've never taken time to do this. I would encourage you strongly to take time out of your day and get these things done. You can get them done. You can get these done through programs off the internet. So let's move on. Okay, there's a bunch of different accounts. And again, I'm going to wind things down here in just a couple minutes. Let me see if there's some other questions here. I'm going to try to see if I can find the chat box here. And anybody, I don't see it coming up there. Okay, I'll just go through the recap and then I'll look. I have to collapse the one screen so I can see better on this. You know, again, a recap of everything is when do you want to plan to retire? For some folks, they don't plan for it, it just happens. Maybe they get hurt. Their health changes so much they have to retire very quickly. For others, it's better to do some planning. Again, it circles around you having knowledge. And the more knowledge you have about your circumstances, probably the better the job is that you're going to do in your retirement. So plan, figure out your expenses, take out a spreadsheet, and figure out what that is, and let the spreadsheet add up to the expenses. Figure out when your incomes are going to be coming in at what months or years. And again, like we have a program that we do that helps with all that if you'd like to take advantage of it. Again, how long would it be? Again, we don't really know the answer, but figure out probably 25, 30 years. How much annual income will you need? Again, everyone's different. It depends on what your needs are. Some years you're going to have greater needs than other years. Are you going to do a once-in-a-lifetime trip to Europe? Or maybe go around the West on a big trip, or go up to Alaska, spend a couple weeks up there. I don't know what your plans are, but figure that in there. Figure that in there. How much will you get in Social Security? Well, you can sign up for Social Security and get your statements, and it'll give you the projections. So you should know that before you retire. If you do want to come and talk with me, you can bring in that information. I'll put it in the module for you. But these are things that you can do on yourself as well. And then your personal savings, of course. Where are your different assets? Does your spouse know where they are? And then figure out where you're going to pull money from first, second, and third. And that'll depend. Maybe in the first years, maybe you have supplemental income that you're not going to have later. In that case, maybe you don't pull so much from the taxable. You pull from the non-taxable or the Roths or the savings accounts instead. So now I'm going to stop sharing the screen. If I can get the chat going here. I'm sorry, I don't see. I see all the people on the board here. Thank you very much for staying with me through this. And everyone's connected, and I don't see where I've got this. Here, I'm going to unmute everybody. Anybody want to say anything before we sign off? All right, if you want a copy of the slides, send us our email. I'll try to figure out how to attach this and send it to you. I'm not really good technically, I'm being honest, but send me your information. So if you want also to do a plan, you can send me your email, or you can pick my phone and number and call me. That's area code 937-912-7850. My email is B like boy, Scarfo, Scarfo @wpcu.troop. I see Charles wants to say something. You got there, Charles? Okay, I don't hear anything. I don't know why it's muted. I apologize. Let me look at the chat here. Oh, great job. All right. Well, thank you for your information, everybody. We're doing other workshops along the way. If you're interested in attending another workshop, please check our at the website at the credit union, and we'll be happy to give you the list of the times and dates of all the remaining. I usually do this one every couple months. I do one also on Social Security and sometimes on Medicare. Thank you so much, and have a great evening. Thank you.